What is going on, everybody? Dan again, Stocktrades.ca. It seems like it has been forever since we last published a video. It's actually only been, 5-6 weeks, but it still does seem like forever, especially because at the start of the year, we were pumping out, 2-3 videos a week. We have gotten essentially so busy on our premium end in terms of new subscribers and even subscriber retention. We have so many people that are sticking around beyond the 1-year subscription that they have, that it has pretty much become our core focus. However, we are here to tell you that the YouTube channel is back. And in this video, with fears of rising inflation, what I want to do is actually go over 6 potential real estate investment trusts, REITs, that you could be looking at today. With that being said, let's get started. So just a quick update on the channel before we do get started. We are working on a podcast that will be coming to you eventually. We're trying as hard as we can to get it out soon. This podcast will focus mostly on Canadian stocks, but it's not out of the question that we could cover some other things. I mean, crypto, I've actually been getting into NFTs over the last, month and a half or so, and what a crazy market that is. But the podcast will be primarily focused on the Canadian markets, but we will also just speak on general investment strategies, the US markets, crypto, all that kind of stuff. And in terms of Stocktrades Premium, just as kind of a gift for us being dead on the YouTube channel for 5-6 weeks, I will drop a link in the description below that will get you 7 free months to the premium platform when you sign up on an annual basis. So a little bit of a quick introduction to what exactly a real estate investment trust is. And if you already know, you can easily skip this portion of the video. But a REIT is primarily modeled after a mutual fund. The business model is to pretty much pool investor capital together and manage everything from, townhouse suites to industrial buildings or office properties. The low capital investment from investors allows them to gain exposure to a multitude of properties, which in turn generates cash flow for those investors. Now, these trusts offer high dividend yields primarily because of their business structure. They are required to pay out practically all of their income after expenses to investors. Typically, you'll see a REIT pay out anywhere from 85 to 95% of its income back to shareholders. And as a result, share prices and the annual growth of REITs in terms of stock price alone are not prone to significant movement to the upside or downside. If you started investing in 2020, the spread of COVID-19 certainly wreaked havoc on the REIT sector. So there was definitely capital gains to be made when they were at lows, but as of right now that share prices are recovered, it's very important we don't think of these trusts as growth stocks, but instead reliable income payers that are known for consistent growth of their distributions. Now, one thing about a REIT that's important too is it does pay a distribution, not a dividend. The distribution can be made up of capital gains, return of capital, dividends. So it's very important. If you have these in a taxable account, you might not be eligible for the Canadian dividend tax credit. So overall, they're just a great way for somebody to essentially become a landlord and collect rent without having to put up the major upfront cost of real estate. With that being said, let's jump into these top REIT plays. And considering there's 6, we're not going to go super in depth on each, but it should highlight a lot of opportunities that you might really have not known about prior to this video. What I want to highlight too, these REITs are not in any particular order. I just want to highlight 6 that you can potentially have a look at and do some more due diligence on to see if they're right for you. So the first REIT that we're going to look at is Morguard Real Estate Investment Trust. So before COVID-19, Morguard was trading around $12 a share. If we fast forward to today, the company is still trading at very depressed valuations. In fact, it's arguably the cheapest REIT in the country. At the time of filming, the company is trading around a 48% discount to its historical averages and a 67% discount to its calculated net asset value. This is the largest discount among all TSX listed REITs, which have a market cap north of $100 million. So why exactly is Morguard struggling? Well, it bills itself as a diversified REIT with a portfolio of retail, office, and industrial properties across Canada. However, it generates the majority of revenue from its retail and office segments. Through the first 6 months of the year, its retail properties, which would include strip malls and enclosed regional centers, saw revenue drop by 8% and 5% respectively. Combined, they account for around 53% of revenue. So the office segment accounts for 46% of revenue, while the industrial, which has been the best performing, accounts for less than 1%. So although this company does have industrial exposure, it is very, very small. Morguard was also one of the first REITs that was forced to cut the distribution during the pandemic, and it slashed it by 50% in May of 2020 and was forced to do so again this past January. So obviously, this is why it is underperforming. It has been highly exposed, and the pandemic has led to higher than average mall tenant failures and restructured rent agreements. The good news, though, is that contrarians may see an opportunity to pick up this company on the cheap. Despite its challenges, a rebound in economic activity and a return to somewhat normalcy will certainly help this REIT. And while the distribution cuts were no doubt disappointing, if you don't own this REIT yet, past distribution cuts don't really mean much. If we look to the company's funds from operations payout ratio, it only sits at around 73%, which is pretty comfortable for a REIT. This REIT provides somewhat of an attractive risk to reward opportunity for those who have some flexibility and are willing to take on a little bit more of additional risk and are willing to be patient. The REIT also does have a pretty attractive yield, yielding 4.23%. By the way, I forgot to mention, Morguard trades under the ticker MRT.UN. So let's move forward on our next REIT, which is Inovalis Real Estate Investment Trust, and they trade under the ticker INO.UN. So Inovalis is an office REIT, and it does have a focus on corporate clients in urban areas. While it is listed on the TSX, the company's properties are actually internationally located in France and Germany, and the majority of its revenue is generated from rental income in France. So while office REITs are still out of favor, Inovalis looks pretty attractive on a lot of fronts. First, the company has strong financial footing with the lowest debt to equity and the lowest debt to asset ratios in the industry at 0.42 and 0.23. It also has the highest FFO, funds from operations, to interest coverage ratio among its peers. It is near double its nearest competitor. So despite a pretty rocky year for office REITs, Inovalis has quietly managed to grow revenue year over year and now has a 6-year revenue growth streak. The company is still trading at a discount to its pre-pandemic highs and a 12% discount to its net asset value. So this has led to an above average yield of over 8.5%, which is one of the highest in the sector. But the main concern with Inovalis is the fact that its high yield may not be sustainable. So while this is somewhat of an attractive opportunity right now, we do need to understand the risks. The company's payout ratio against funds from operations and adjusted funds from operations is 130%, which is simply not sustainable over the long term. But the good news is that the company has introduced a strategy to reduce its AFFO payout ratio to below 95% in the next 12 months, and they want to get it below 85% within 3 years. So right now, the payout ratio is simply too high, and the proposition with this REIT right now would be that management manages to lower that payout ratio. And can it get there? Well, the company certainly has the resources and a strong management team to execute. The payout ratios were below these ranges pre-pandemic, so there's no reason to think that they can't hit the targets again. With that high payout ratio, there is no question that this REIT is likely the riskiest on this list, but it's also compelling on a number of fronts. It remains undervalued and provides a very attractive starting yield, one that could actually continue growing if they do hit those targets. 5-year performance, Inovalis has underperformed the TSX primarily because of the COVID-19 drop and its inability to recover as fast. So the next REIT on our list, which is actually one of my favorite prospects and is kind of a unique REIT, that is Automotive Properties REIT, and it trades under the ticker APR.UN. So we know the price of used vehicles. We know the supply chip shortages that causing devastation in the automotive market. The small cap REIT has a load of potential. They buy car dealerships and then they rent those locations back out to the operators. The company locks tenants into long-term agreements of a decade or longer with rent escalators because the operators value stability. So if you own a clothing store, you can pack up and move to a new mall or a new area relatively quickly. You can imagine the absolute mess it would be to pack up a car dealership and move. That is a lot of inventory. That is a massive job. So since the company's 2015 IPO, it has more than doubled the size of its portfolio to 66 dealerships and 2.5 million square feet of leasable space. The company has properties from Alberta all the way to Quebec and is continually looking to expand its network. So dealerships use automotive properties to accelerate their own growth prospects, considering they can expand much faster if they actually don't have to buy the underlying real estate. Dilawri Group is Canada's largest group of car dealerships, and they essentially give the REIT first dibs at any dealerships that it sells. So Automotive Properties portfolio will expand as more dealerships get sold to these big operators. COVID-19 did slow the expansion plans, and there is a potential that some dealers could try to renegotiate rent, but these are long-term businesses that want the stability. They don't want to abandon these locations just because of a few short months where they don't make any money. The company has improved its balance sheet. Its debt-to-equity ratio now stands at 0.922, back from 1.91 peak in 2019, and its payout ratio is only using 69% of FFO. The company actually does yield 5.96% as well, so it does have a blend of both income and growth. So in terms of 5-year performance, Automotive Properties has outperformed the TSX by quite a wide margin, actually. You can see that it collapsed during the pandemic, but people quickly realized that this REIT was still performing quite well, and it has outpaced the TSX in terms of overall recovery quite drastically. So our next REIT is an industrial REIT, Dream Industrial REIT. They trade under the ticker DIR.UN. So industrial real estate is obviously the hot sector right now. E-commerce is taking the world by storm, so much so that even major retailers like Walmart and even grocery stores like Loblaws are participating. As a result, everybody wants to own industrial properties that can benefit from the growth in e-commerce. The more companies that adopt and grow e-commerce platforms, the more distribution space will be needed. So Dream Industrial REIT stands out as one of the few REITs poised to grow the top line by double digits. So the REIT started 2021 out with 177 properties. After selling some of its lower quality assets over the last few years, it used the proceeds from the sales to pay down some debt, and at the end of June, it had a pretty attractive debt to assets of around 36% and an attractive debt to equity ratio of 0.66. So with such a low amount of debt, the company has the capacity to make a lot of acquisitions. Management has stated that they can make another $275 million of acquisitions while still keeping its debt to assets below 40%. So even after all of that growth, Dream Industrial is going to have one of the safest balance sheets among REITs. Through the first 6 months of the year, their portfolio stood at 215 assets, and it has around 38.5 million square feet of leasable space. Keep in mind, this is up from 27.3 million just 6 months ago. It's also increasing its rents. In the last quarter, which I think right now would be the Q2 of 2021, the company signed new leases with a 22% spread over prior rents. This is still a very healthy spread, even though it is less than it has done previously. And to top things off, occupancy rates are rebounding from a pandemic-impacted year. We're seeing occupancy rate jump from 94.7 at the end of 2020 to 97.4 at the end of June 2021. Company has already added over $1.8 billion in acquisitions in 2021, and with over $650 million in liquidity, don't be surprised if they add more. So on the surface, it does look expensive. It has a price to FFO ratio of 25. But the thing is, investors are paying for the growth of Dream Industrial REIT. This one has kind of a middle-of-the-line yield for real estate investment trusts in the low 4% range. And if we look to the 5-year performance, this has been one of the best REITs to own in the country. As you can see, we're looking at more than triple the returns of the TSX index. So the fifth REIT, which is back to more of a rebound play, and that is Allied Properties REIT. They trade under the ticker AP.UN. If you are a believer that office REITs are due to make a comeback, then Allied Properties should be at the top of your list, but it should be one that you're looking at pretty in depth anyway. This is a company that has 194 rental properties valued at over $8 billion, 13.9 million square feet of gross leasable area. Of that, and this is key, 81% is located in either Toronto or Montreal, and the remaining portfolio is in other large urban centers like Calgary, Edmonton, Ottawa, Vancouver. So its office segment does make up the majority of net operating income, but it also does have exposure to some urban data centers, which account for around 17% of net operating income. Why mention this? Well, this segment is seeing some pretty significant growth as they are critical to Canada's communication infrastructure. The company is highly diversified and no tenant makes up more than 5% of revenue. This is pretty key. The top tenant is actually an unidentified cloud service provider, which accounts for around 4.9% of revenue. So with this REIT, you're looking at a low 4% yield again, and the payout ratio in terms of funds from operations is in the low 70% range, which is considered a pretty safe payout ratio for a real estate investment trust. Further to this, Allied is actually one of only 8 REITs which have achieved Canadian Dividend Aristocrat status. It has a 9-year growth streak, and this is the second longest growth streak among all TSX listed REITs. And to top things off, the company is arguably one of the best capitalized REITs in the industry. It has one of the lowest debt to EBITDA, debt to equity, and debt to asset ratios among all office REITs. The company's interest coverage ratio of 5.3 is also second to only Inovalis REIT, which we spoke about earlier. So while Allied carries additional risk as an office REIT, analysts are still expecting double-digit annualized revenue growth over the next couple of years. This is among the highest of all TSX-listed REITs. This is a REIT that has a strong portfolio of assets, an impressive commitment to the distribution, and a pretty strong financial profile, but as an office REIT, it does pose a little more risk. And as a primarily office REIT, as we can see by the performance, it has struggled mightily. Pre-pandemic, this was a REIT that absolutely crushed the TSX index. But as we sit right now, it's underperforming by almost 50%. And moving on to our final REIT, that is arguably one of the most popular in the country, and that is Canadian Apartment Properties REIT. So in this environment of uncertainty, especially with inflation, there are 2 REIT industries that have stood out in terms of performance, and that is industrial and residential. Obviously, with residential, there is none larger than Canadian Apartment REIT. So this company has a market cap north of $10 billion. This makes it more than 4 times larger than its closest competitor. They operate over 65,000 rental properties in Canada, Ireland, and the Netherlands. And analysts are expecting around 14.5% average annual revenue growth over the next couple of years, which is the best among the industry. So worth noting, actually, CAPREIT has grown revenue year over year for 23 consecutive years, which is the longest streak in the country. And as a result, it is trading at a slight premium to NAV, but that is because it is providing excellent value and has provided sector-beating returns for a very long time. So it's a Canadian Dividend Aristocrat. It has established itself as one of the most reliable income stocks in the sector at a 9-year dividend growth streak, which, as we mentioned, is tied with Allied Properties for the second longest growth streak among REITs. And the company has one of the strongest financial profiles of all its peers. In terms of residential REITs, it's among the leaders across all debt-related categories, and it has a industry-leading FFO to interest coverage ratio of 2.38. So one thing about CAPREIT, it does have a relatively low yield. It's only in the middling 2% range. But the one thing you need to consider is this REIT has provided significant capital returns as well. It's outperformed the TSX index by more than double over the last 5 years. And overall, if we are worried about inflation, property values tend to do well and tend to rise in inflationary environments. And they can also pass on those inflation costs to renters through rate increases. Overall, if you're looking for a residential REIT, Canadian Apartment Properties REIT is arguably the best in the country. So everybody, that's it for the video. Really hope you liked it. We're entering a period where inflation is crazy high. I mean, we're seeing the highest CPI increases since, I believe, 2003 on a year-over-year basis, and interest rates are no doubt going to be on the rise. We warned premium members about this ages ago. I think it was in early February or March that inflation was not just going to be a temporary thing, no matter how much they want to tell us in this environment. it was pretty obvious what was going to happen. So we prepared them with 3 outstanding real estate investment trusts that we added to our model portfolios back then that have been some of the best performers in their portfolio this year. REITs are very good during inflationary times, which is probably why a lot of you are looking at them right now. If you aren't, at least you should be. And I really hope you like this list of 6. Do us a favor, drop down in the comments. Let us know what REITs you're looking at today, even what stocks you're looking at today. Let us know what videos you want to see. And remember, there is a discount for 7 free months to Stocktrades Premium down in the description if you want to join our platform, which is one of the fastest growing in the country. So really glad to be back on YouTube, and we will see you next time with more great Canadian content.